the quarterly update, we're back, and it's with the person who I've been trying to track down. I've been lucky to have Cole a couple of times, have had Tim McKinnon and obviously Danny. We've been trying to get you on, so it's good to actually come to where you are.
These blokes are smarter than I am, Ollie. You're in good hands.
Now, I think, well, we've had a relationship with you guys since you started. I think I'll probably always just say that LAWD and Humans Vag started at the same time, but it really was a call from John McKillop after the initial Xandom Award in April of 2021, and he said, "Ollie, would love to just help you cover a few of your costs because we think what you're doing is a fantastic thing." So,
Very, very cool, Ollie, and congratulations on all your success.
oh, thank you. And I think, yeah, thank you guys for supporting it because you've been there for us since our infancy. I want to talk real estate with you, Danny. Obviously, it's an area you know quite well. When you were explaining just how the different areas of the market, and I think nearly simple is fantastic because we can overcomplicate things. But can you just explain the different tiers of the Australian rural property market to me, like I'm your son?
So, Ollie, this is a highly fragmented market, fragmented by geography, quantum of money, and commodity. And so, when people talk in generalities about the market, and sort of treat it as one market, I get regularly frustrated. But, it's difficult for people to not talk about it that way unless they're going to go and do a deep dive into a geography or a commodity. What's happening in dairy farms, or what's happening in cropping land in the sheepweed zone up the Neil Highway. So we all do talk in generalities, but in terms of the way I view the market, it occurs in tiers, if you like, or strata. And so you have what I would call the local markets, the mum and dad markets, where people are trying to affect farm build-up. They're trying to buy a farm next door. They're trying to buy another farm in their district. And typically speaking, a lot of those families, it'll be the bulk of the transactions that occur. They're looking to transact something which is regularly less than $10 million. In the times of free money that we've just been through, a lot of those farmers were transacting up to $20 million. Then beyond that, you've got what I would call your larger established families, and they're sort of almost corporate families now, if you know what I mean. And so, typically speaking, you would see those in the up to $20 or $30 million segment. So they've got more resources, they're well established. You can think of who some of the sort of families would be that would do that, and even some of the large Queensland graziers. They're typically looking to pull something on that's, 20, 30, and maybe even $50 million if we're talking about, one of the northern pastoral industry guys, the privates. And so they act more like a corporate. They've got an infrastructure. They'll have CFOs and a head office and all of those things that they're operating. And they're big and very serious businesses. And so, again, in that period of free money, that's probably the segment of the market where I saw some of those guys make really big moves, to set themselves up for the next, 2-3 generations. And then beyond $50 million, it's really traditionally the space of the institutions. That's where you see, your large direct investing pension funds or your funds of funds, acting. What we did see in that period of very low interest rates and good, strong commodity prices is there were a couple of those corporate families that moved into the institutional space and went head to head with them. And so you did see a couple of the families do $200 and $300 million transactions, but they were doing it off a $1 billion base, if you know what I mean. So they're very, very big family interests. So when we talk about where the market's at, below $50 million, where it tends to be private money and families, and typically speaking, where they need to go and borrow money to affect that farm build up, to build their portfolios and build their businesses, they're the guys that are most affected by that really rapid, 13 increases in interest rates. That's the part of the market where the sentiment gets cruelled by an announcement by the bomb of an El Nino. That's the part of the market that's sensitive to, that rapid decline in red meat prices, cattle and sheep prices. And so that's the part of the market that the end of, 2022, end of 2023 and into the start of 2024, was really affected. in the part of the market that I'm lucky enough to spend, a significant amount of my time in, which is the institutional part, above $50 million, that's been quite different. There's been a lot of capital available. They're not trying to borrow money. They've been coming into the country, if it's foreign money, at 65 cents, which is pretty attractive. And so the top part of the market's still been transacting. It's still been quite liquid. And of course, that goes against everyone's intuition. They say, oh, but hang on, how could that possibly be? The bulk of the market, most of the stuff that people are touching and feeling, the families and the people that are in the market all the time say, how could that work? Things are tough. Cattle prices are horrible. How could they be transacting? But the top part of the market's been quite liquid.
And so when someone says, "Oh, we've got a two-speed market," that's exactly what it's referring to.
Yeah, that's exactly.
Gotcha. Okay, makes sense. Um, what are the so on that, are the are the corporates seeing something that the family farms aren't, or it's just that they're not as volatile to the three main fluctuations?
No, they're all still trying to do the same things. For the family farmers, it's about capacity and liquidity in bank lending and those sorts of things. So I think everybody drew breath. We saw a very dramatic decrease in cattle and sheep prices, and some of the guys who've been around longer than me said it's one of the sharpest changes that they've seen. And so I think that really rocked people's confidence, including banks, advisors, and everybody else. I think everybody said, "Geez, nobody ever wants to catch a falling knife. They want to see that the trend is back on an upwards trajectory and that that's going to look sustainable before they get going again." And we are seeing that now. So all of a sudden, in Q3 2024, and we are seeing a lot of activity. So a lot of that spring activity that we're going to see in the market, the spring campaigns, whilst there'll be a lot of properties on the market, I think there'll probably be buyers for a lot of it.
So the last decade, was it property prices have tripled in terms of land values? Are we going to see we've already seen a slowing of that? Is there do you see a point in the future where it starts to get maxed out, or can you, looking over the horizon, see that?
Yeah, so I think, traditionally, if you look over the last, say, 50 years of agricultural land prices, you see these periods of rapid gain. And those periods of rapid gain are sometimes a catch-up. So some of what we've seen in the last decade, I think, has been a catch-up. And then some of it's, been overbid. And so in markets like, say, Western Victoria, 5 phenomenal seasons in a row, low interest rates, land use change, grazing land going into cropping, technological advancements, massive yields. People were confident, they're full of cash, there's plenty of bank debt available, and they went forward, and some of the families down there made some big purchases. I think that's a market that's probably come off. There are other markets that tend to track sideways, and so those that really did get overbid in that last 12 or 24 months have probably adjusted down somewhat. Others that were still rapidly increasing, but probably didn't have that little spike at the end, I'd say they're probably tracking sideways. But yeah, in terms of what's likely to happen going forward, we're hitting a really interesting demographic point, at sort of an inflection point in terms of farm ownership. And there are a group of owners there who stayed on for the last 5 years because of the incredible times that we were experiencing. It was like the 1950s wool boom, they're making more money than they'd made in the 20 or 30 years before. And so people that would traditionally have sold out by then stayed on. And so now I think we're probably hitting a point where there's going to be some older landowners that are perhaps in their 70s and 80s that would have traditionally have sold by now are going to say, well, now I really do have to sell. And in fact, I'm happy to accept a 2022 price, not a 2023 price or a 2021 price. And so those guys will quit, not because they're under any pressure, but just because it's time. And so we might see some adjustment to price expectations there. There'll be others that are under no pressure at all that won't sell. And that's what you typically see. You see a stalemate between vendors and purchasers in those sorts of markets, and that's why values track sideways. There's probably small pockets of distress. So, private credit coming into our market, some people that overextended and whatever else are going to have to quit. Some of those people, if they're pressured, may accept a lower price. But typically speaking, what you tend to find in markets like this is that things track sideways. I think in terms of where the market goes forward, we'll have this period where we track sideways. I think there are commodities and geographies that will continue to increase in value. I think water, because of scarcity, will increase in value. People who are exposed to, cotton or other things where you can sort of forward sell and have some clarity about where you're going for 2 or 3 years in advance. I think they'll probably continue to grow and consolidate. A lot of big growers there, and so that'll continue to, give really good support to prices. People in cropping that are looking to do more farm build-up, I think will have to pay up if they want nearby or adjoining land. And I think the larger scale beef producers, if what happens in beef going forward is as I think it will be, and I'm talking my own book because that's what I'm exposed to, then I think you'll see a recovery in prices there and just a gentle uptick over time.
And so for people who are listening, we get quite a lot of younger people, as you could imagine, Danny. But like, is there questions, given this change that we're going to see in Australian farming, especially from the family farmlands, is there questions that next generation coming through should be starting to ask of advisors and just starting to get curious more broadly to help them understand where the market and where the future's going?
Yeah, and there's probably two aspects of that. So if you're growing up in a well-established family, you should be having discussions with your family about, what's it mean for me? What role do you want me to play? Have we thought about succession? Who's interested in terms of your siblings? Who's interested in farming and who's not? Do we have a plan? And so what you don't want to do is not have a plan and find that something's got to be sold because the financial succession that needs to occur can only be by cash and not by some other arrangement. And so that's important. If you're not in that situation and you're in agriculture and you're like me and you don't have any money at the start, then you need to get started. And I get asked this question often at different things that I speak at. Oh, what about the young farmers? How do they start? And I'm a little bit brutal. And I say, well, they've got to start as they always have had to start. They've got to start where they are, not where they want to be. And so if you're an aspiring young farmer, buy some gear and do some contracting, buy some livestock and lease some land, just start to build some assets. You got to just start where you are, not where you want to be. It's a little bit like the career thing I was talking about in the last podcast. A lot of young people are a bit forward and want to start somewhere where they're not and think that it's everybody else's responsibility to get them there. Well, it's not. It's theirs. And so they've just got to go and pay to learn like the rest of us have. Buy some livestock, buy some equipment or whatever. Find a little plot. You can start on 100 acres. You don't have to start on 10,000 acres. So, and then build some equity, pay your cows off, and just keep building assets until you get to a point where you can step into something.
The question I've got, and it comes back to the institutional side of things, but I've got a few mates in Melbourne, I'd say, so far removed from agriculture, aside from owning a pair of RMs, but now starting to become more interested in it. Are there new entrants coming in, or do you foresee a lot more, private equity, family offices, and overseas buyers coming into Australia?
Yeah, there's a lot of that money coming in, Ollie, and family office money domestically, but probably more out of Europe coming in. And so some of that money has bought into, natural capital, nature-based solutions. We're going to do a global good by investing in agricultural land, and it's going to be part of the carbon solution. All of that stuff's great. But some of that money's prospectively less informed. I think the guys that do that successfully out of those family offices or even private equity and whatever else are the guys that partner themselves up with, best-in-class operators who are already existing farmers or existing fund managers. And so, hopefully that money finds its right home and is well advised, because, what we don't want is for them to come here and have a bad experience. We want them to come here and have a good experience and send more money. the issue for some of that new money is if they have no property background at all, or if their property background is from commercial real estate, where you're just renting a bit of three-dimensional space or something, they often don't understand, what drives your return, your cash return out of ag. The active nature of the business that's conducted there, and how important the decisions are that the actual farmer is making in being able to achieve those earnings. And so, there's the 1,000 decisions that a farmer's making that they're doing based on their intuition and experience. A lot of these investors have just got no idea about, and it's almost impossible to explain it to them. And so, those guys just need to make sure that they're well advised and that they're not trying to do it themselves.
Also, like with the growth of corporate farms in Australia, and this is something that's only just popped up, now we've got greater case studies as well of what's possible. So whereas previously the northern pastoral industry was a handful of big players, like across horticulture, across other areas now, there's more case studies of success hitting the market, isn't there?
Yeah, there is. Yeah, and there's some great operators around. People like GoFarm. I know you've done a thing with Liam. There's managers out there now who can take those accounts on, who can devise a strategy for them and then execute the strategy for them. And so that's really important. Coming into this without a strategy, without a clear a goal or some clear outcomes that you want, whether that's carbon or biodiversity or pure play ag, coming into it without that will mean that you're more likely to fail. You really need to make sure that you've got good advisors.
Is there any fads that you're looking at and just going, oh, this is just a whole lot of noise for nothing?
Yeah, there's aspects of the nature-based stuff that concerns me, and so in all of these things, we're investing in commodified natural resources. So land is a commodified natural resource. We've got a title, it's indefeasible, we own it. Water is a commodified natural resource. We have a title, so many megalitres, it's volumetric, it trades, there's a market, and we understand it. ACCUs, carbon is a commodified natural resource. And so the market is clear, and ACCUs trade for a level of value. What sits underneath some of the ACCUs is prospectively vexed from time to time. And so there are all the different methodologies about, how carbon is sequestered. Some of it I'm really comfortable with. There's a tree growing out there. It's got carbon in it. Some science, sits around how much carbon is sequestered in that tree. I get it. I get more concerned about some of the stuff that's less clear than me being able to see that tree. So some of the aspects around soil carbon, I think the jury's probably still out on. What you want to know is that what you've got is an indefeasible right, and that it's not going to get burnt down or which that tree can do. but what are the implications to you in losing that? Does it create a liability then? I still think there's some maturity to come through in the market about some of those other methodologies as it relates to carbon. There's also a whole lot of mystery surrounding, some of the renewable agreements. That's not a very transparent market. So what does that mean for property by property? Is it additive? Are there negatives that come around that? So markets to function well need really clear information, and some confidence that what you're buying is real. So I still think there's some immaturity in some of those new income streams that are coming through in ag. They're not a fad per se. I don't want everyone to think that I'm a Dorothy Downer on all of this stuff. I just think we need to see some more maturity and some more security in what those things are.
And so what's the role then of government in this? And I ask that hesitantly, but knowing, like, has the market actually run ahead of where government's understanding and the regulation is?
Yeah, I think, in their efforts to meet, prospectively arbitrary targets that the global community signed up to at 2030 and 2050 and whatever else, that some of these things are being done in a rush, um, uh, with unintended consequences and not lots of thought and whatever else. That'll all shake out over time. You just want to make sure that you're not one of the ones that gets shaken out. And so there are two aspects to this. Sometimes a first mover, with great confidence and conviction can make a lot of money because they're a first mover. Other times pioneers get the arrows and the settlers get the gold. So as it relates to, this big transition into renewable energy, as it relates into this stuff in relation to ACCUs and the various methodologies, I would say to investors, inform yourself, understand it all, but don't necessarily rush to jump into it straight away. I think as there's more maturity, there'll be prospectively better deals available.
And so one final question, Danny, on the deals front. Any feature sales or uh, updates that you want to share?
Yeah. We've had extraordinary amount of property in the market in that above $50 or $100 million space this last 12 months. There's a whole lot of that's been really well received. Things like One Tree, for example, that we took to market recently for the Proterra team. We're in stage 2 of our sale process there. Very, very strong engagement. And we expect that will be done around the guidance, around the 250 million. We've got another asset in the market at the moment I can't talk too much about, at around the 250 million. Again, very high engagement. Look, I think quarter 3, quarter 4 this year is going to be fairly good, and I'm feeling quite good about the amount of momentum that the market will have, and that we'll be enjoying, our clients will be enjoying rolling into 2025.
Fantastic. Well, Danny, thank you so much for your time.
Goniali, thank you.